Hey Bowtie Nation, Joseph Hogue here with some exchange-traded funds that I almost guarantee you haven't heard of, but should definitely watch. You know we love ETF investing here on the channel for that core part of our portfolio for those stress-free returns. In this video, I'll share the 5 ETFs beating their index, 5 small funds that don't get a lot of attention, but could be a solid part of your portfolio. I'll share why I like each and what types of investors each is best for. I'll also show you the special ETF Screener on StockCard that I used to put together our list. I'll leave a link to StockCard in the video description below. Click through and then go to Portfolios in the top menu. You'll find the Bowtie Nation portfolio in the Stock Picks section. It's free to follow, and you'll get email notifications whenever I buy or sell from the list. Don't forget to use the promo code Bowtie Nation, all one word and lowercase, for an exclusive discount beyond the free trial. We're getting started, but before we do, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I'm excited to get into that list of ETFs because some of these I hadn't even seen, but I'll show you that screener and why I picked these later in the video. First on our list has been a hot one lately, the GraniteShares Commodity Broad Strategy ETF, ticker COMB. This ETF gives you diversified exposure to commodities like oil, gold, and agricultural products using 23 commodities futures contracts for that exposure. And so you can see, while commodities haven't returned much over the last decade, there are times when having that exposure to this asset class pays off big time. The fund has returned over 26% in the last year, most of it just recently on that surge in oil and agricultural prices from the Ukraine invasion. And I put this one first because most investors have little or no exposure to commodities. They might own a few mining stocks, but not the kind of diversified exposure you get with an ETF, and that can be really important as a hedge against some of the inflation, geopolitical risks like we're seeing now, or maybe even just macroeconomic trends. The fund charges a 0.25% expense ratio, which is really low for these smaller futures-based funds, and you can see the fund breakdown here. About a third of the fund is in energy, natural gas, and oil. You've got also 20% in grains, which has helped it post that 26% return recently. Now, even after we reach some kind of negotiated settlement on Ukraine, inflation is going to remain a big issue. So whether it's this fund or one of the larger ones, like maybe the Invesco Commodity Tracking Fund, ticker DBC, any investor that wants that diversification away from stock volatility should look into one of these commodity funds. The Spyder Multi-Asset Real Return ETF, ticker RLY, has a similar objective for that inflation protection, but goes at it in a different way. Now, this one is a fund of funds, meaning it holds shares in other ETFs to build out that portfolio. The objective here is to provide that inflation protection through domestic and international real estate, commodities, and commodity businesses. So you can see here, it owns funds like the S&P Global Natural Resources ETF. It holds 3 funds with exposure to US and global real estate, the Metals and Minings ETF here, and even some inflation-protected treasuries. This one does pay out a 1.93% dividend yield, though the expense ratio is a little higher at 0.5% annually. Again, though, that is fairly low, and this one provides a more diversified list of those asset classes, including real estate, beyond just the commodities one we saw in the last fund. Now, I don't necessarily think you need both of these since they're both going to have that high commodities exposure and the inflation protection objective. The multi-asset fund has done similarly with a 26% return over the last year, but a little better on the 3 and the 5-year time periods, though again, these commodity funds, they haven't done that well over the last decade with just a 2.5% annualized return since 2012. So understand these are great when inflation gets higher and you need that production and the higher commodity prices, but they tend to lag during a bull market. But we've still got 3 more ETFs to highlight, but I wanted to take you through the screener here to show you how I found these and what I'm looking for in funds to add to my portfolio. We can click on Tools here in the menu to find the ETF Screener and toggle either of these to screen for stocks or exchange-traded funds. And there is a lot of criteria here to filter our funds, but I want to use just a few to start our search. First, I'll scroll down here and filter only for funds with less than 50 stocks. I could have gone a little higher here, maybe funds with less than 100 stocks, but I did want to keep it small. Now, there are plenty of ETFs holding hundreds and even thousands of stocks. It's great for getting that broad exposure to an asset class, but sometimes you got to wonder if they're just too diversified. Even with 50 stocks in a fund, each one is just 2% of the fund assets. So even if that stock doubles, it's only going to add 2% to the total return. So here, I'm really trying to find those funds holding a limited number of stocks with the chance to run higher on some great picks. Next here, we'll scroll down for returns and toggle the box for only those funds that have outperformed the market. And this has outperformed their index. Now, this one is self-explanatory, right? I wouldn't necessarily disqualify a fund or sell an ETF if it underperforms its index for a given year, but if you're investing on that management expertise in picking good stocks, then you want something that consistently beats the market. There are a lot of other great ETF filters here. You can screen for dividend ETFs as well as those with certain country or regional exposure, all to the point of finding that one ETF that fills the gaps in your specific portfolio. Now I'm going to make this one simple though and keep it open and just scroll down to this expense ratio box and toggle the filter for those funds with a low expense ratio. And then at any time you can click apply here and see how many funds meet your criteria. Here we have 63 ETFs you can research to see which fit best with your portfolio. Now this is a simple one, that expense ratio, but so often overlooked by investors. You always hear that statistic that the average fund managers fail to beat the market. Well, most of that is right here. The funds with the higher expense ratios just don't typically beat their index by enough to cover those expenses. Nation, this is one of the most important factors to watch for in your ETF investing. So please make sure that you're not paying too much in these expense fees. This next fund, the Spyder Global Allocation ETF, ticker GAL, is also a fund of funds and a strong all-around portfolio fund. And now for any of these funds, you can scroll down on Stock Card to find the top 25 holdings in that ETF, as well as the weight of each investment in the fund's assets. The Global Allocation ETF has a pretty broad objective of capital appreciation with that international diversification. It invests at least 30% of its assets in stocks and bonds from other countries. Scrolling through here, you can see it's diversified across those developed world stocks with 20% in the SPDW ETF, as well as emerging market stocks with the SPEM. It also holds bond funds from these treasury ETFs to corporate and international bonds. Then it's going to round out that exposure with some sector stock funds for stocks in the S&P 500. So this is actually kind of like a complete portfolio in one fund. It holds about 60% of the assets in US and foreign stocks, another 26% in bonds, and even has some of that commodity exposure, and 4% in cash. So I like this one for that all-in-one approach, but would say that you need to understand the asset breakdown. That 60-30 split for stocks and bonds is probably good for investors in maybe their late 30s or early 40s, but maybe not for the younger or older investors. Younger investors might want more in stocks, while older investors would probably want more of that safety in bonds. Now, considering that broad diversification, it has done well. The international stocks and bonds have meant that it lagged US stock returns, but also made it a smoother ride with a 7.2% annual return over the last decade and nearly 10% annualized over the last 3 years. Now, this one also pays a 1.93% dividend yield and only charges 0.35% in expenses. Two more ETFs to watch, but I want to get your input on this as well. What do you look for in an exchange-traded fund? What themes or factors do you like to see in funds that you buy? So scroll down and let me know in the comments below, what ETFs are you buying and why? The Cambria Global Asset Allocation, ticker GAA, is similar to that Spyder fund with some important exceptions that mean different investors are probably going to prefer this one. Now this is also a fund of funds, so it's investing in 27 other ETFs, and the objective here is to use a quantitative model to match returns on the global market portfolio of investable assets. So this is just saying, don't try to beat the market, just own funds that give you the entire market. And you see it in the funds here with exposure to stocks, bonds, real estate, and commodities. This one holds quite a bit more in bonds though, with 41% of the assets in fixed income, along with 50% in stocks and the rest in real estate and commodities. So it doesn't appear quite as well diversified as that Spyder Global Asset Fund, but it's probably a little less volatile with the higher bond weighting. So check this one out if you're looking for that lower risk. Returns are similar here though, at 7% over the last year and 9% annualized over the last 3, but it does pay a slightly higher dividend at 2% yield. And this next fund has a really interesting strategy and the highest return of the 5. The Simplify US Equity Plus Convexity ETF, ticker SPD. The fund seeks to track large cap US stocks, basically the S&P 500, while using an option strategy to protect your capital when the market sells off and accelerate returns when stocks are rising. And just a look at the holdings is interesting if nothing else from a portfolio strategy perspective. The fund holds almost 98% of its assets in the S&P 500 ETF, so basically just investing directly in that index. Then it's got all these call and put options. It had 16 different options when I checked, at different strike prices and expiration dates in an attempt to produce that lower risk in down markets and higher return in up markets. And in fact, it has done its job with not only a 15% return over the last year, but a slightly better performance versus the S&P 500 over the last few months. Now, the fund has outperformed the broad U.S. index by about 1% over the last 3 months and by 3% since inception. Now, that's not a huge difference, so it might not hold over longer periods, but the fund does charge a relatively low expense ratio at just 0.29% and pays a 1% dividend yield. Check out our 2022 portfolio on StockCard or click on the video to the right for the 7 monthly dividend stocks that will pay your rent. 7 stocks to put cash in your pocket every single month. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.